Michael bought in Pimpma, settled in 2016, bought it for $436,000, currently valued at $1 million. Current profit, $633,000, 1,453% return. Susan, she bought in Strathpine for $356,000, currently valued $823,000, current profit $466,000, 1,300 return on investment. 1,162 people a day coming into Australia. And for every 3 people that come into the country, we need 1 dwelling. So that 1,162, we divide that by 3, but we need like nearly 400 houses to be built every single day just for these people to live somewhere. Let that sink in. This is the elephant in the room, because the Labor government are trying to blame capital gains tax discount, but really at the end of the day, it is Labor's policies that are actually putting prices up. Hello and welcome to the Positive Property Podcast. This is George Markoski, your host. Tonight, we're talking about the growing pressure in the Australian property market. On the surface, parts of the property market appear stable, but these structural pressures are building. And what is this all about to do? So we're going to talk about that tonight. Okay, last week talked about CTG, the capital gains tax. And this week, what I want to talk about is what's happening in the property market. But also what I'd like to do is really delve down and show you the stats behind the scenes, because it's all about numbers. Because what happens is when we invest in property, we've got to look at the macro and look at what's happening on a macro level, and what macro is the big level. And then you look at the micro level, because in Australia, so for example, Australia is one market out of 189 countries or whatever it is in the world. And what I like to do is I like to look at the whole world as a whole. And funny enough, we're going to show some stats today about what I predicted about several countries about property and what's been happening. I should really get my old stats out, which is very exciting, because what I look at is demographics, because demographics tells the story. Because when it comes to demographics, what are we looking at? One, we're looking at population growth. Population growth is probably the biggest driver of property prices, because when it comes to property, or really any commodity, anything, when it comes to anything really, there's only 2 parts you can look at. You've got to look at supply, you've got to look at demand. And really, that's the way it looks. And when you look at supply and demand, and you look at the fundamentals that give you a clear picture of the underlying demand and the underlying supply, then you can work out, is this thing going to go up in value or is it going to go down in value? That's what it comes down to really at the end of the day. And what we do is, sometimes I feel like I'm a political commentator because I comment about politics all the time as well. And the reason I'm not that interested in politics, but politics writes policy and policy affects money. And that's why it's very important. Because you look at a country is run by a political party, and literally it's like the prime minister or president is the CEO of a company, and the GDP and the national debt is their profit and loss. And what they're doing is they're doing different things to try to balance the budget and keep everything running. So I guess running a country is like running a big business. And as investors, we need to be aware of what's happening in the world. And, in Australia, we like to be aware of what's in Australia, but also we like to be aware of what's happening in United States, what's happening in China, because China and United States are big trading partners of Australia. So we need to know that as well. But I also like to look at Canada, New Zealand, and other Western countries that have got similar demographics to find out what they're doing in their property market and what's happening and what's affected it. So we can learn from that and probably get some clues so we don't get stuck or get caught out. So for example, New Zealand, property prices dropped in New Zealand, right? And actually next week, I'm going to go through all the stats to show you how much they've dropped, why they've dropped, and what they're doing about it. And the reason I want to show you this is because I look at that and think, okay, when this happens in Australia, what's going to happen in Australia? Because we've always got to keep an eye on what's going to happen, because no one's got a crystal ball. But what we can do is look at all the factors and try to guess what's going to happen. And at the moment, there's a lot of pressure building in the property market. And there's pressure with different things, and I'm going to go through that now and show you. Okay, the growing pressure in the Australian property market. So on the surface, Australia looks very steady. Prices in many areas have held. Rental demand is strong. There's no broad collapse. Stability does not mean there is no pressure. And this is what's happening at the moment. These are the things that are causing the pressure. Interest rates remain restrictive. Household debt is elevated. Population growth is running ahead of supply. Construction activity is constrained. And lending conditions are tighter than most people realize. So individually, these things are very manageable. And if you only have one thing, it doesn't matter that much. But together they cause pressure. So what I want to do today, I'm not going to be talking about headlines. I'm going to be talking about the data and show you what it means and how it's going to affect the property market. So this is the state of the nation at the moment. So construction is not keeping pace. And you've heard me bang on about this all the time. And this is one of the levers. This is one of the things that's putting pressure. So recent construction activities remains below the level required to close the existing supply gap. So housing projects typically take 12 to 24 months from approval to completion, which means today's weaker approvals reduce supply well into the future. And that's the big issue. So even if approvals stabilise, the current pipeline does not support a rapid recovery in completions. And if you look at this line up here, the red line, that's Albo's housing target. And you can look at approvals, the blue line, and then look at the completions. And you can see approvals are a lot higher than completions. But if you look at 2022, look at the amount of approvals and the amount of completions. And now that trend is happening again. So this is the other challenge, right? The build cost remains structurally higher. Detached construction costs surged more than 30% between 2020 and 2023. Although growth has slowed, cost level remain well above pre-pandemic norms. So higher land, higher labour and material costs compress margins and reduce the number of projects that meet feasibility thresholds. So basically, it's harder to make a profit as a developer or a builder, which is bad because then it's harder for them to actually build more and develop more. And this is the reason, I tell mums and dads, don't go out there and try to become a developer, because even developers that have got experience are losing money developing properties. And there's construction companies going broke every week, and it's happening this year as well. So construction is falling behind the economy. So over the past decade, output per hour in construction has barely improved. So if you look at the market sector, this is the orange line. It's gone up, right? So mining and professional services have lifted materially. So basically what this means is for every hour worked by someone, we're getting more done. But when it comes to construction, it's actually gone down. So when output doesn't improve but costs rise, supply becomes slower and more expensive to deliver. This is just a fact. Now, build times are getting longer. The amount of quarters now, units now take 9 quarters on average to complete, up from 6. And houses have moved about 2 to 3 quarters to close to 3 to 4 quarters. So reducing annual turnover of new supply. So what we're going to look at is we're going to look at the supply side. And when it comes to the supply side, we're looking at approvals. Then when you look at approvals, then you've got to look at, okay, what actually gets started? Now, even the stuff that gets started, which is not everything gets approved, takes longer to finish. So the whole chain slows down, putting more pressure on the supply side. And there's an underlying pressure that's growing. And when you take a lot longer to build everything, this makes a big difference. Developer margins are under pressure. So because construction costs have risen significantly faster than consumer inflation since 2020, higher labor material costs lift the base cost of every new project. So if the sale price doesn't rise at the same pace, margins compress and the project stalls. And this is the thing. So you look at this graph here, you look at consumer price index, how much it's gone up, and you look at house construction gone through the roof. And part of this is materials and the supply chain that happened in COVID. But not only that, what's happening now is the government is doing a lot of big projects that have taken a lot of skilled labor off. And I think this is part of the reason that per hour, how much we're getting done is not as much, because all the people that are really good, they're working with the government, getting a cushy job, building infrastructure, getting ready for the Olympics for Brisbane, building tunnels. There's a $15 billion tunnel they're building in South Australia. South Australia now has got a $30 billion nuclear submarine facility they're going to be starting building. So there's a lot going on. So you're getting skilled labor taken away from housing. So what happens is you get the not so skilled labor. And these guys can't build as fast or as good. Therefore, it costs more. And this is the thing. The pipeline is not translating into supply. This is the pipeline. So the number of dwellings under construction surged post-2020. However, completions have not risen at the same pace. So the stock approved but not yet commenced projects remain elevated. So there's a lot of stock projects, properties sitting in the pipeline longer. Why is this happening? Well, one, what happens is because the developer starts one project, that takes longer to finish. Therefore, they can't set the other project up, so they've got to wait. 2, if a project is not profitable anymore, they have to sit on their hands and wait because you can't just build it and lose money. So what happens is if you've got some land and you want to build some property, but it's not feasible anymore, what developers tend to do is wait, because as they wait, the property prices go up and then suddenly it becomes profitable again. That's what they need to do as well. So you've got all these factors that are slowing things down. And because of that, the pipeline's not translating supply. So even though our pipeline's not even that big, but it's not even getting close to what we're doing. Investor demand is reaccelerating. So investor housing loans have climbed back towards cycle high. Investor lending now accounts for roughly 35 to 40% of new mortgage flows. This recovery has occurred despite mortgage rates remaining well above 2022 levels. So the orange line is investor loans and blue line is investor loans as well, just purchasing existing dwellings plus new dwellings on top of that. Now, recently we had rate hikes. Now, despite the latest rate hike, clearance rates remain around 70% across major capitals. Now, auction volumes are rising and results are stronger than the same time last year. This is crazy because basically when auction rates go up, what follows straight after that is price going up. It's very correlated. So the government actively shaped demand. So what's happened is the 5% deposit scheme is bring forward demand for eligible buyers by reducing the deposit hurdle. But what it's done, it's concentrated demand under certain price caps, increasing competition in that band. So what's happened is, if you look at the current price cap, New South Wales Capital City and Regional Centre, 900,000, and then October 2025, 1.5 million. New South Wales Other, 750,000. Price cap, 800,000. So that's all changed. What's the next target? The Albanese government is reportedly considering reducing the CGT discount from 50 to 25%. The reform is framed around improving housing affordability and reducing speculative demand. Critics argue that the current discount disproportionately benefits higher income investors and encourages capital to flow into existing housing rather than new supply. Even before legislation is introduced, policy risk can alter investor behavior. This is the latest thing, and I'm going to show you some stats about this, because the International Monetary Fund, they did a study, and the government is saying that investors with the capital gains tax discount is the problem with our housing, and I'm about to prove to you it's not. So the notion that changes the capital gains tax discount is 1995 were the major driver of Australian house price surge is contradicted by the following chart from the IMF, showing real house prices globally booming in unison. So you look at this, and Australia, United Kingdom, New Zealand, Canada, United States, Sweden, the whole of OECD all went up the same. Now, only one country had a capital gains tax discount, that was Australia, but all of them went up. So it had nothing to do with it. In actual fact, excessive population growth is what is driving the house prices. That's the fact of it. So this is the elephant in the room, because the Labor government are trying to blame capital gains tax discount, but really at the end of the day, it is Labor's policies that are actually putting prices up, because what they've done is they're creating more demand where we don't have enough supply by having such a big population increase in our country and the record immigration. The IMF's 2025 article report in Australian explicitly signals out the nation's inability to build enough housing to keep pace with its world-leading population growth. Immigration, as a key driver of the strong house price increase recorded this century. Australia's dwelling investment as a share of GDP slightly exceeded the average. So if you look here on the left, there's only one country that's got a bigger population growth than Australia, and that's Israel at the moment. You look at the population growth here. You look at Australia and you look at Israel, then you've got Ireland and Canada. All these places had massive property price increases. And then you look at Italy, look at the population growth. It hasn't grown at all. It's almost nothing. And that's why you can buy a house in Italy for €2 in villages, because they've got no population growth. It's all about supply and demand. Yes, so Australia's population growth was the second highest in the whole of the first world. And you look at this here. So this graph shows you population growth has been a contributor, probably the single most important contributor to Australia's high house prices. As you can see all the different countries here, and you look at annual population growth and then change of house prices. And what have we noticed? There's a graph. Higher population equals higher property prices. Very basic. The same can be said for Australian rents, which have risen alongside strong population growth. The reality is that Australia's chronically high rate of immigration is the bigger contributor to Australia's expensive housing, both to purchase and rent. Then tax settings like the capital gains tax discount. The working age population, that's what it is. So the affordability situation in Australia is very unlikely to improve in the near term, given that the National Housing Supply Affordability Council and KPMG both forecast that housing demand driven by population growth and household formation will outpace new supply for the foreseeable future. This is the pressure that's building. Busting Albor's housing myths. In social media posts late last year, Housing Minister Claire O'Neill claimed, why is housing so tough right now? Because for 40 years our country hasn't been building enough homes. Is that true? No. Let me show you these stats. So if you look at this, we've got a massive housing deficit, but the reason we've got a massive deficit is not because we can't build enough properties. It's because we've got too many people coming in. So this is Australia's rolling 12-month dwelling completions, 2019 to 25. And then this is basically Australia's additional working age persons per dwelling, rolling annual ratio. So if you look at this is comparing Australia to Canada, United States, and UK. And this is a really important graph because, a lot of people having a go at Australia not being able to build enough houses. And I'm here to bust that myth. Australia actually does a brilliant job of building homes, achieving the status of Anglosphere champion in per capita dwelling completions for 37 years straight. So basically, but various governments over the last 20 years have chosen to run migration intakes that have significantly outstripped the ability to supply enough new homes and not stunt household formation rates. So you look at here, annual dwelling completions per 100,000 people. Australia is above Canada, above United States, above UK. We are just really good at building houses compared to the rest of the world. The other challenge is rising land costs. And the reason land costs have gone up, you'd think Australia, we've got so much land, we're such a big country that we'd be able to get enough land. But the challenge is, with land, you need infrastructure. But also there's red tape with government and everything else. So there's a lot of expenses with getting dirt and turning it into property development, right? And if you look at this blue chart, residential land values have gone through the roof. And you look at commercial and rural land, hasn't gone up much at all. So it's increased 7% over the last year to a record $8.3 trillion in Australia. So 75% of Australia's properties is land component. So the median lot price in Australia has risen by 46% since 2019 and 540% since 2000. Also, construction's gone up, labor's gone up, materials have gone up. And there's median lot values in the capital cities, Greater Sydney, Melbourne, Brisbane, Adelaide. And as you can see, they've all gone up. And lot size has gone down, lot value has gone up. Okay, so strongly listing lot price alongside high material costs and labour shortages are the major barriers to building homes for Australia's rapidly growing population. The supply curve for housing construction has shifted to the left, reducing the volume of homes built and increasing their cost. Now, look at this. I don't want to get political, but you look at Hawke and Keating. This is net overseas migration per day in office. Hawke and Keating, 256 people per day. Howard, 407. Rudd Gillard, 617. Abbott, Turnbull, Morrison, 610. Albanese, 1,162 people a day coming into Australia. And for every 3 people that come into the country, we need 1 dwelling. So that 1,162, we divide that by 3, but we need like nearly 400 houses to be built every single day just for these people to live somewhere. Let that sink in. Now, the other sad thing is Australia's replaced the mining boom with a government spending boom. So we had a massive mining boom back in the day, but now we've got a government spending boom. They're doing the biggest projects they've ever done in history. So you look at resources and public sector cycles. You look at back in 2010, and we had that massive mining boom, which was happening. And now mining's gone down, and now public demand has gone up a lot. It's huge. As a percentage of GDP, nearly 7% of our GDP comes from us building stuff in Australia. Now, we need infrastructure because we've got so many people coming in. So I'm not against infrastructure, but it's taken jobs away from a lot of people that are trying to build properties. So unlike the mining boom, the growth in public demand is being funded by taxpayers and is concentrated in less productive sectors, such as health, aged care, and NDIS. So the Labor government's always going to do this. The public demand now accounts for 28.5% of GDP, far above the pre-pandemic average. So if you look at NDIS, 2016, how much money we're spending on NDIS, and you look at the age pension, and now the NDIS is spending as much as is almost as much as the age pension in Australia. The NDIS alone costs 50 billion a year, and it's projected to exceed 100 billion. Now, I'm all for, helping people, but unfortunately, the NDIS has been a massive scam with lots of dodgy people scamming the system and making lots of money. We've got a larger share of healthcare workers and social services than other comparable countries. If you look at Australia up there, nearly 16%. The problem with these non-market sectors, they've got low productivity growth and basically they make the country stagnate. It's really crazy that we've got that many people working in social services and healthcare. So public demand does not respond to rate hikes like households do. So the RBA has to work harder and keep rates higher. Spending grew 5.9% last year and is forecast at 4.5% this year. Economic growth has stayed below 2.1%. To ease inflation, public demand must fall towards 25% of GDP. That has not happened in 3 years. So, how Albo turned immigration into an inflation bomb. Inflation stayed weak during the last immigration boom for two reasons. Chinese migrants bought capital that funded new apartment supply, and rents fell from 2014 to 2020 despite strong population growth. When unit completions keep pace with immigration, rental pressures ease. Conversely, since 2022, Albo unleashed a cost bomb in housing construction when he refused to contain the East Coast gas cartel during the Ukraine war. And the worst part is he spent fiscally like a drunken sailor, but Labor always do that. So the market's not punishing property investors. It's punishing investors without a strategy. If you're looking to invest and expand and refinance the structure, you need to get clear on this because you need to structure the thing properly. Let's go to our wins. Real people, real results. Michael bought in Pimpmart, settled in 2016, bought for $436,000, currently valued at $1 million. Current profit, $633,000, 1,453% return. Daniel bought in Callumvale, 2016, bought it for $421,000. Now it's worth $925,000. Current profit, $503,000, 1,200% return. Susan, she bought in Strathpine for $356,000. Currently valued $823,000. Current profit $466,000, 1,300 return on investment. So that's what's happening. So what I want to do is say thank you to everyone. See you soon.